Welcome to Viking Capital's Hero webinar. I'm super excited. My name is Vikram Raya, and I'll be your host tonight. I have my good friend here, Chris Paranello, our Director of Investor Relations. Chris, welcome to the show, my friend.
Thanks, Vic, and thanks everybody for joining. We're really excited to launch this product tonight, and I've had a chance to speak with a lot of you over the last few days once you caught wind of it. This high level, I think, is gonna be really informative.
Awesome. So, guys, first of all, I want to wish you everyone a happy New Year. It's 2024. Overall, the sentiment is positive. People are excited about where the economy is going. People are excited about where real estate's going. I really think that we've navigated a very challenging couple of 24 months. But with that being said, I really want to, again, welcome a lot of the current investors to Viking Capital, a lot of our new investors that are interested in learning about Viking Capital. We founded Viking Capital in 2015 as really a different kind of firm, a firm that was interested in looking for opportunities where others couldn't find them. And we're looking to present these opportunities to professionals, to physicians, to entrepreneurs in the field who are looking to diversify their income, looking to look for tax advantages, diversification, appreciation, cash flow. And we've decided to specialize in one asset class, which is multifamily. And this investment thesis, this premise was because I really feel like, my background's in cardiology. I've been an entrepreneur for many years, but I like asymmetric risk reward where, you invest some amounts, but you get way more on the upside. And that's what multifamily provides. And that's why we really love this asset class. It's not a luxury asset class. It's a necessity asset class. That means no matter what economic cycle, what part of the country, everyone needs a place to live. And so that's why we at Viking Capital have focused on that. With that being said, I'd like to go to the next slide. Again, we've created sort of an all-star team. We invest all over the country. Our main pockets that we like to invest in is the Sun Belt, places like Georgia, Indiana, Texas, in several markets. We're in Washington, D.C., we're in Tennessee. So there's a lot of sort of these pockets that we feel like there's a lot of opportunity. Other places that we're looking into investing are in Florida and the Carolinas. We've created an all-star team, of which Chris is one of the key members. And I found this company, again, with my partner, Ravi Gupta. And again, we really believe in being an investor-centric firm. And we personally are investors. We invest in our own syndications. We invest in other people's syndications. And we really believe in being aligned with our clients and our investors. So as I advance this next slide here, a little bit about our track record. We've been around for almost 10 years now. We've acquired 25 properties. We have about $800 million of assets acquired. And, we've crossed the 5,000 unit barrier, and our returns over our 9 exits have been close to about 24% average annual return. Next slide, please. Yep. And I couldn't have done this without our team. Our team is really the backbone of our company. I'm super proud of them. And it's because we can act like an institution, but give that boutique investment feel that we are able to blend both sides of the coin, if you will. Ravi and I, as I mentioned, we're both physicians and we founded it. Can we go back a slide, please? Judah is our vice president of acquisitions. Many of you met him, have talked to him. Amanda's runs our operations department. Ashley is our marketing and produces all this amazing content as well as these decks. Our director of relations, Chris, whom you just met earlier, is really leading an all-star team. And then one of the unsung heroes of our company is Ed, and he's our director of asset management. He really makes these properties sing when we take them over. And if there's any challenges we have to navigate, he helps us navigate them so we can, protect capital preservation and at the end, create a profit for our investors. So I'm going to pause here. I'm going to ask everyone in the chat to maybe put where you guys are from and what's a financial goal for 2024 for you guys. Let's put in the chat box. Let me engage you guys here a little bit. Guys, we have people from all over the country, looks like. We have almost over 100 people here. Good. We got Tanya from the Bay Area. That's amazing. We got Raman from Modesto, uh, Rookman from Atlanta, Jason from Charleston. We got Atul from Oregon, man. We got so many people from all over the country. This is amazing. And people want to diversify. They're looking to learn more and educate. Fantastic. Good. We got Norman. Norman, good to see you. Camille, Nita, awesome. Christina, Gaurav. Thank you guys. Great. So next slide, please. So Chris, we got a full packed house. And
Yeah.
before we jump into it, um, what are you excited about, man? What's going on in your neck of the woods?
Yeah, I mean, I'm excited about this fund. I'm excited about the last deal that we closed, Stewart's Mill. You got a lot of sports happening. Super Bowl's coming up.
Yeah. Who's your pick?
I'm gonna go with San Francisco.
Okay, okay.
Oh,
I like the Chiefs, man. So
see?
my father-in-law's from Kansas City, so I'm gonna go with the Chiefs. But yeah, guys, it's a good time of year. Right now, a lot of our team is out in San Diego. There's one of the largest multifamily conferences in the country. It's called the NMHC, National Multifamily Housing Conference. We're going to get the latest data from the top economists out there. We're also going to get potentially some of the latest deals that people have been holding on to for a while, waiting for the right time. And we're getting a sense that the next 6 months will be an increased amount of deal flow before the institutions start coming in, which we expect from insider knowledge that it will probably be the second half of this year. But before we get into all that, I just want to be very honest and transparent of what we're all seeing in the news. So next slide, please. You know, it's an interesting time when you look at some of these news articles. The Wall Street Journal is talking about, $1 trillion coming due of loans that some people may not be able to pay. Next slide. The Real Deal did an expose on some of these syndicators and multifamily investors out there saying, hey, when these loans are coming due, can these syndicators pay or do they have to turn in the keys? Next. And people who joined the game late, we've been doing this since 2015, but there are people who joined from 2020, 2021 onward, got into the game of investing in multifamily real estate, didn't have a really full-fledged plan thought out, and once they hit adversity, boom, their apartments become ghost towns. And this is what you're seeing. You see the green pool here, deferred maintenance, and investors eventually got left holding the keys, left empty-handed. Next slide. So some of the information that we're getting a sense of all over the country is there's some investors, syndicators, multifamily owners, and other investors that can't keep their head above water. Next. So one of my friends always said, history doesn't repeat itself, but it rhymes. So what does that mean? Well, you guys know, you guys were around in 2008. What happened, right? Home prices fell by 31.8%. A huge bubble, right? 3 million foreclosed homes. The bailout was almost $500 billion. Unemployment skyrocketed, mass layoffs, banks shut down for a while. Next slide. And so we're not in that kind of crisis. That was probably a once in a generation type of crisis. And in fact, a lot of the regulations from that time, the Frank Dodd and all these other things were put into place so that doesn't happen again. But there is a crisis and there is a challenge now. And where there's, the Chinese character for crisis, if you guys know it, if you translate it, it means crisis and opportunity. It's two words together that mean that term. So keep that in mind as I sort of lay out the problem. So what is the problem, right? The problem is this, guys. I'm going to lay out the scenario, if you will. I'm going to take my gloves off and we're going to go all in here. So what happened? We got the pandemic, right? 2019, 2020. What resulted was almost an economic catastrophe. And so what did the government have to do? They had to intervene. And what they did was they pumped trillions into our economy. So did the Fed with some quantitative easing. That resulted in us averting that major crisis. And they probably overpumped, money. They probably put too much liquidity in. And that resulted in an economic boom. And there was already a real estate rise going on, but on top of that, they added fuel to the fire. And so they had a real estate explosion of growth. And because the tight regulations from 2008, the type of debt, so the typical agencies that normally lend, like Fannie Mae, Freddie Mac, which are government subsidized, those agencies weren't able to lend during this kind of volatility of both good and bad, right? So the only type of debt that was available out there was really this floating rate or variable rate debt, and it was higher leverage than normal. Normally, leverage is about like 70, maybe 75. This was getting closer to 80% leverage. And there's some investors out there even went crazy and got 90% leverage. Because it's variable rate debt, what do? They wanted to protect themselves against the rate going too high. So the normal thing, and this is probably required by the lenders, was to buy rate caps, which are upward ceilings of how far the rate could float. That's fantastic. That was a good move. As inflation spiked, what did the Federal Reserve do? They raised rents 11 times. This, created such a stress on these deals, even though they were hitting the rate caps. When the rate caps have to come for renewal, which these rate caps are only good for about a year, 2 years, potentially three. The Sorry, thanks, Danny. I meant to say the Feds raised rates, not rents. Um, so as the rate caps came due, the initial rate cap, which would have been $200,000, ended up becoming $2 million. Right? It's almost 10x the cost of a rate cap. On top of that, compounding the problem was the values of these properties may have dropped, right? It could have been because of rents softening. It could be because, as interest rates have risen, that sometimes causes these cap rates to expand instead of compress, and that can change the values. And also, a lot of these people had capex money or rehab or renovation budgets set aside to do for renovations. But when this crisis happened with the debt, they used that money to pay for the rate caps, and they were unable to infuse it back into the property. And so the NOI got stagnant. And so all these things together created a perfect storm. Next slide, please. And so right now the opportunity is $1.2 trillion of outstanding CRE debt, of which almost half of that is maturing over the next 2 to 3 years. And this is in multiple asset classes: retail, industrial, office, and multifamily. And as I mentioned, we specialize in multifamily. And so we see an opportunity. As I mentioned, that Chinese character for crisis is also a dual character for opportunity. This is the opportunity. When people say there's blood on the streets, be greedy, and when there's there's wealth out there, be fearful, right? This is the time to be looking for opportunities. Next slide. So we know the current economic landscape has a lot of lenders out there. There are traditional lenders, there's brokers, there's big banks, there's local banks, there's equity funds, there's debt funds. Typically, the traditional lenders have very strict criteria to lend. Number two, they also have limitations on the check sizes, not by writing too big, but they don't go too small. Meaning the minimum check size could be 10 million or 20 million or 15 million, but they don't usually write $2, $3, $4 million checks. So what this does is create an opportunity for institution like groups to come in and follow the same criteria these lenders, but go ahead and capture some of this space, this what we call small pref equity investments. Next slide. And so I'm going to pause here and ask you guys, where are you guys in your emotions of where we are in terms of the economy? I've done this slide a couple of times, but it's interesting because I get different answers every time we present this slide. So are we anxious? Are we denial? Are we fear? Are we panic? Where are we? Are we optimistic? Are we euphoric? Where are we at, guys? Put in the chat box. Let me see. Okay, I got Amos saying hope. There's a potential for hope here. Schwab saying hope. I'm seeing a lot of hopes. What else, guys? Come on, put in the chat box. Where do you think we are here? Ramen saying thrill. Okay. Gaurav saying anxiety. Yeah. Cautiously optimistic, anxiety. Yep. So absolutely. So that is there's sort of a wide variation of what I'm seeing here, but when we did a informal survey to our own investors, a lot of people are worried about their anger, depressed, to hope this kind of thing. And what that shows us is we're closer to the bottom than we're to the top. In fact, with the Federal Reserve in their dot plot projection showing 3 rate cuts, and then Goldman Sachs recently announcing that they expect 5 rate cuts this year, we think the future is probably brighter than the current. Timing obviously is no one can really see the crystal ball, but that's the trend. The trend probably will be in the next 3 years, interest rates will be lower than higher. I think you guys would agree with me. So that being said, next slide. The opportunity is this. Next slide. We're looking for operators, deals, and investments that have amazing location. They're in top places in the country, Austin's, Phoenix's. They're in Atlanta's. They're in Dallas's, Orlando's. These are strong places to buy. Number two, we're looking for good underwriting. The numbers make sense. The NOI is phenomenal. We're looking for the property maintaining its value. We're looking for operators who have a strong track record. We're looking for good property management companies. But the only thing is perhaps not there is they have this floating rate debt and they're looking for someone to help them with their next rate cap, or they're looking for a little bit of support in the refi, or these are new deals. They're ready to go. They've raised like I said, let's say it's a $15 million raise and they raised 14 million. They're looking for the last million and they're willing to pay extra for that last million. That's what we call gap funding. And the final scenario could be, hey, the government has so many subsidies for ESG, which is, environmentally sustainability kind of things. To put solar on the roofs, water saving fixtures, all these things. And so to have that added on so they can get those government grants or that funding, they're probably looking for capital. So these are the very small scope that we're going to look for with this very tight criteria and take advantage of the market opportunity. Next slide. So as we talked about, these are exactly the reasons why some operators who are exemplary operators would simply need support. And Chris, what do you think is really the opportunity here for funds like ours?
Yeah, I mean, the real opportunity here is to reduce risk. In any traditional LP investment, where you're landing in the capital stack, which you can see illustrated here on the left, is under common equity. The closer you are to the top of the capital stack, it's usually the lower return, but severely lower risk. So your senior debt, your Fannie, your Freddie, they're up there in that debt portion of the stack. They're collateralized by the underlying real estate, and they are the least amount of risk. Coming in as pref equity, the real opportunity here is that you're sliding in between the common equity and the debt in a prioritized position. So even, for those of you who have worked with Viking in the past, we usually have something similar to this as one of our tiers, Class A, which is a prioritized position, but still common equity. Pref would slide in even above Class A, and really you're getting to negotiate terms with who you're supplying the pref to, and that could, bring a current pay, that could bring a higher pref than you would get in your traditional Class A. And it also gives the opportunity to kind of negotiate GP share and things like that, depending on how big the need is.
Hey, Chris, I want to just stack on what you're saying. So is pref equity a new concept or has it been around?
It's definitely not a new concept. So if the reason it might seem new is usually the people that are providing pref are institutions. So think REITs, think, Walker Dunlops, Arbor Groups, really big groups that are dealing with ultra high net investors and they're usually placing larger pref checks. Viking even used pref in a couple of its recent acquisitions, which we're going to be doing a case study later on to kind of talk about that a little bit. But typically you're looking at a $5 to $10 million check size. So what the HYRO Fund is going to allow us to do is be a little bit more nimble and kind of fill the gap in that $1 to $3, $1 to $5 million range.
Cool. Next slide.
So the benefits to investing in pref equity. So the biggest benefit is you're getting cash flow in a market where cash flow is hard to find. This we'll get to the returns, here in a little bit, but to get an 8% current, and then still have some back end, flexibility for when deals are sold, plus potential of GP share, as deals exit, really, really great place to be with a low risk profile. It's still a fund, so you're getting really great diversification, different types of investments, all in the same asset class of multifamily, but stacking on different areas and different, ways in order to protect yourself, which brings you to decreased risk. And the best thing is that, when you invest in the HYRO Fund, your cash flow is accruing from day one. Next slide.
So this is really the opportunity. So first of all, we had a inordinately extra amount of time coming up with a name. So if you guys like it, great. If you don't, help us come up with a better one on the next round. We do these things, but we're like, all right, what should we call it? And so we're just trying to go back to what it is. It's high yield. It's resilience, because we're in a part of the economic cycle where we're offering support to certain types of folks. We're also looking for opportunities for new kind of investments. So that's where the name came from. And so if you're Greek, you'd call it HYRO. If you're not Greek, you call it HYRO. I don't know. But really what we're trying to do is target 2 to 4 assets across the country that we think make sense. And we're going to deploy small check sizes, 1 to 4 million. We're targeting 1980s or newer, or properties that have really been heavily renovated so they look like, newer properties. A+ to B assets. We're not trying to go garbage style deals. We're not looking for C and D, because that's risky, right? This is a risk averse fund. This is a opportunistic fund where there's opportunity. We're targeting the first tranche to be about 10 million. We're looking at a hold period of about 1 to 5 years. Some of these deals, they don't need the funding for that long, so they'll turn it right back around. Other deals will take a little longer. So we'll play with the timetable there. The other interesting thing I want to share is we've done funds in the past where we moved that model and didn't do our traditional deals that we normally do, and we did it more of a fund model. We found that our investors really liked us doing single asset syndications and deals. And so rest assured, we are going to be doing single asset and syndications as well. This is just an additional opportunity for you to get either further diversification or to invest in a different way, in a different part of the equity stack, the capital stack. So we are expanding our offerings and giving you more optionality at Viking Capital. Next slide, please. Now this is you, Chris.
Yeah. So the fund structure, how does it work? Stacking on what Vic said, these properties and the opportunities that we're going to be underwriting and placing capital in, the fundamentals are there. They have the occupancy. They're growing NOI. They're doing all the things that they thought they were going to be doing. They're just facing a little bit of adversity when it comes to, interest rates, and they might have to, redo their cap. They might be trying to make a decision right now whether to spend the CapEx money on, doing the renovations, or whether to use that CapEx money to pay for a rate cap extension to keep holding on. So, we're targeting these types of assets that are doing really well, that in any other market would be, screaming along. You're getting diversification across all the fund assets. However, like Vic mentioned, not all of these deals are going to be in the fund for 5 years. From the sponsor's perspective, they want to to get us out of there within a couple of years in most cases. And when they are able to get these properties turned around and they dispose of them or they buy us out of the deal, we're able to shore up the investors. They're getting that 8% current, but when a deal exits, that's when you're going to get the back end pref and hopefully some of the GP that we're able to capture as well. All of the investments will be secured by a preferred equity position. So you're really sitting at the top of the capital stack. So when the sponsor does sell the asset, it's going to flow down that traditional private equity waterfall where the debt service is going to get paid, that loan is going to get taken out, and the next person in line to get shored up with is going to be the HYRO Fund. Then after that, they can take care of their traditional equity and themselves as the GP. Let's see. It's a really great opportunity to create cash flow in this part of the market cycle, and it's backed by Viking Capital. So one of the things that we are going to build into the language of all of the deals that we're providing capital to these deals is Viking will help organize and make sure that they're right back on the right track, just like we've done with our own deals. But in addition to that, if for whatever reason they go delinquent on paying the HYRO Fund, we'll swiftly be able to take over the operating company and work with their lender and really take a hands-on approach to fixing the asset. Next slide. Okay, investment at a glance. So if you're familiar with Viking, we like to break things up into investment classes. The HYRO Fund's no different. You're going to have a $50,000 minimum investment. The projected investment time is 1 to 5 years. But like I did mention, as deals exit the fund, there will be payouts made to all the investors that are in the fund. The investment classes, which we'll go through on the next slide. Okay, so more investment at the glance. Pref equity, quarterly distributions. You'll start accruing the day that you invest, but the actual payouts of your cash-on-cash distributions are going to come quarterly, and $50K minimum and $1 million maximum on this. Keep in mind that unlike a traditional Viking acquisition, where we're usually raising somewhere between $15 and $25 million, these are small investments that are very strategically placed between $1 and $5 million. So when we do open an opportunity with the HYRO Fund, there is going to be limited participation just due to the small nature of the capital injections. Okay, return by class. So Class A, Class B, and Class C. Unlike traditional Viking acquisitions, the only difference between these shares are your investment amount. So from a 50K to 100K investment, you're looking at 11% preferred return. From 100 to 250, you're looking at 12%. And for above 250K, you're looking at a 13% preferred return. In any class, the current pay, or what you can expect annualized in your quarterly distributions, is 8%. And then under that, you'll see up to a 17% IRR. So this is something I want to be very transparent about. Preferred equity does reduce risk quite a bit because of where you're positioned in the stack. And the one part of this deal that isn't protected by being at the top of the stack is any negotiated GP share that we make with a sponsor that's taking on this capital. And because they really need this capital to help stabilize their deals, what a lot of these folks are doing is they're pledging interest in the general partnership of that asset, or if we don't feel like that asset's good enough, we might ask for GP share in another asset. Now, all of those GP shares and that value is going to be dependent on the success of the deal. That's one of the ways we're aligned with the sponsor to help make sure that these deals work out and they get turned around. Now, as an investor in this deal, we don't just keep that GP share for Viking. After the preferred return, there will be a traditional equity waterfall where any additional profits are split 50-50 with all of the investors in the fund. So that's your way of getting up to a 17% IRR is through that back-end equity that we're negotiating with these sponsors. But I caution people, that GP equity could be worth zero or it could be worth millions of dollars. So as you're assessing your own risk profile, really feel comfortable with the preferred returns because that's where you have the most protection. Projected investor return. So just like we just discussed, this is a hypothetical investment of $100,000 in the Class B share. So that's looking at a 12% preferred return. In year one, quarterly, you're going to be getting $2,000 every quarter for a total of $8,000 for each year. So that's going to come out to $40,000 on a $100,000 investment over the 5-year hold. Now, the accrual is that spread between 8 and 12 that's back-ended that you're going to get when properties are sold and disposed of from the sponsor and the fund gets that capital back. That's going to make up an additional $4,000 on a $100,000 investment, taking you to $12,000 per year or $60,000. So just in the preferred equity, you're looking at a 1.6x equity multiple. Okay, case study. So this case study is really less of a case study and more of revisionist history. So in 2023, Viking bought 2 properties, Crossings at Eagles Landing and the Crossings at McDonough. Now it's Elevate Eagles Landing and Elevate Green. Both of these properties were bought as a portfolio together. And one of the ways that we were able to get to that $55 million equity need was bringing on 2 different pref equity providers. We used Walker Dunlop and Arbor Group. These folks, one wrote a $10 million check, one wrote a $5 million check. Now, the pros and the cons to having pref come in an acquisition like this. So one of the pros is traditionally they want to be considered as debt. So they're not taking any of the bonus depreciation. The Viking HYRO Fund will also not be taking bonus depreciation. So this isn't a vehicle for you to get more depreciation. But the pro for a group bringing on pref is that they're maximizing the depreciation because the pref isn't taking it. The other really big plus for bringing on pref is they're capped. So when you're building your model, if you have a 16% IRR or higher, 15%, 14, whatever it is, if it's higher than the pref is capped at, then you're getting, a much better deal for your common equity investors, assuming you can perform to the model that you put in place.
Yeah, guys, and really, this enabled us to do these. Like, it was $100 million deal, one of the biggest in Viking history to take down. And it was nice to have institutions that brought this kind of pref equity for us to help us do this, because we brought probably 80% of the capital, but we needed that 15 to 20% capital in a short amount of time to get the deal done. This is the exact same type of vehicle we like to be for other opportunities out there, and it's a win-win. Next.
Okay, financial opportunities. So you're going to get profit on the sale of an asset. So you're going to get that 8% current regardless of what's going on with the fund. The HYRO Fund is only going to take on opportunities that can pay that current. When properties are sold, you get shored up with. Cash on cash returns, 8% cash on cash. You compare that to other deals that are going through acquisition cycles right now. The last 3 or 4 deals that Viking has done have ranged from 3.5% in year 1 up to maybe 5.5%, 6% in year 1 for the strongest cash flowing deals. This is giving you 8% in a preferred area of the capital stack. You're accruing your distributions from the day that you invest. Your non-market dependent returns. You're not waiting around for Viking to find its next deal, which we go through hundreds and hundreds of deals to find them. This is a vehicle that you can put your money in and it'll start earning from you right away. And it's pretty risk averse. You're at the very top of the capital stack. You're in front of all of the common equity, and you're really getting an institutional quality investment. Why would an operator need to partner with the HYRO Fund? We went over some of these already, but to reiterate, rate caps. Like Vic said, using variable rate debt, most lenders required some minimal purchase of a rate cap. Really smart sponsors really dug in, bought extra years up front at a lower price. Now, given what the spread above SOFR is, even today with rates coming down, the SOFR rate doesn't come down quite as quickly as the rate that you would get fresh debt with. So a lot of sponsors out there are looking at new valuations at today's BOV, at today's cap rates, and they're a few $1 million off. But if they can just get that stable fixed rate debt for 3, 4, 5 years and a refinance, they have an opportunity to save all of their investors' capital, and reduce all of the risk of having to turn the keys in or any other kind of variability that they might deal with. So stability is what folks are buying when they bring on the Hero Fund. Gap funding on new deals, just like Viking used with the Crossings deals. There's a lot of folks out there that don't mind giving up a little piece of the GP and giving preferred economics for checks of $4, $5, $6 million or higher. Hero can provide that and give Viking investors who know that we're going to put an extra set of eyes on this underwriting and make sure these deals are as strong as our deals, to give you preferred terms, maybe even better deals that you can get from Viking on traditional Viking deals. Cash in refis, as values are temporarily lowered due to expanded cap rates, anytime you're going to go and get a refinance, there's typically going to be either, at best, you're getting cash neutral. But if you need $1, $2, $3 million, it's another price that you pay to get stability for all of your LPs and, not have to go back to them and do a capital call. Complete capital expenditures. We talked about how when interest rates rose and debt service for variable rate loans skyrocketed, even if you had a rate cap, you were paying more than you were when you bought the deal. What a lot of sponsors were forced to do is take CapEx money that they raised that they hadn't used yet and keep their head above the water. Now, the only way to bring these deals back into the green is to do those renovations. They might not have the cash to do it. The Hero Fund's going to be able to help bridge that gap, assuming that the business plan is still viable and Viking believes in the deal and that it can be turned around. And then secondary financing for ESG. I think we have a case study coming up for this one, so I'll cover that in the case study. Vetting the asset and the operator. This is something that as Viking has acquired 25 deals, has worked with institutions that vetted us, and we had to pass those stringent, vetting criteria to get the pref equity. We really feel like we have the right people in the right places to determine which deals are viable and which deals aren't. And we will negotiate with all of our experience to get the very best deal for our investors. Really what this means is we're setting up criteria that Vic's going to go over in the next couple of slides and really, being conservative as possible on making sure that the property, so the difference between this and vetting our own deal is when we are vetting a deal and we're modeling it out and we're bringing on a lot of you alongside us as LPs, what we really have to make sure is A, that we can pay our debt service, B, that we can pay any kind of pref equity that we brought in, and then C, that we're able to create the returns for all of our common equity and LPs, and then D, that we're able to create enough of a profit for Viking on the back end that this is profitable for us. When you're evaluating a deal for the Hero Fund, it's a little bit different. It's still important that the common equity, gets the money that they're looking for. It's still important that there's some GP share. But really what we're focused on is after debt service, can they pay the 9% current that we need in order to pay the current to our investors? Are they able to, at the end of this deal, pay the 13 or 14% that we're going to charge them? If they can only pay us and they can't pay their common equity, that isn't what anyone's looking for. But it gives us a little bit of a better negotiating line because we're really focused on how the Hero Fund is productive. We're also going to offer a set amount of equity. So typically the pref equity placements are going to be under 5 million, really 1 to 5 million.
Yeah.
And Vic will go over the asset criteria here.
So the key is, as in marriage, as in most things, proper selection, right? So you want to, and we've been doing this for almost a decade now, so we really know, we can smell a deal from far away. We can smell good operators. We know what it takes to succeed, and we'll use that same lens to look at all the deals that will come across our plate. Number one is debt verification. We'll understand everything about the debt. We'll have, a debt specialist probably go through all of these things. We'll have a very in-depth application funnel that they'll have to fill out all this details, and we'll review all these things and see if it makes sense. And probably our acceptance rate into this will be less than 10%. Occupancy and collections, we're going to audit them. We're not going to just take what they're saying, just at face value. Property valuations, we're going to get a updated property valuation so we know what the property is exactly worth. We're going to look at the fundamentals, the KPIs, the key performance indicators of the asset, and make sure that everything outside of the debt is on fire. Also, the underwriting. We have artificial intelligence on top of like our huge database of deals that we've already taken a look at across the country. Plus, we have this, we have a huge team across 3 continents looking at deals for us. And so we'll put it through that very tight cipher and filter of underwriting to make sure that this deal passes muster. Next slide, please. In venture capital and in private equity, they always care sometimes more about the team than the startup or the investment that they're investing in. We're no different. We really believe a good deal can be messed up by the bad operator, and a bad deal can be salvaged by a good operator. So we really are going to care a lot about who is the team, what's their track record, what's their performance, are they self-managing, are they vertically integrated, or do they have a really good third-party property management company? And what are their values? Are they in alignment with our values? And so I think it's very important. Next slide. So, the markets that we have unfair advantage and expertise is going to be Indiana, Texas, like we're in Austin, Dallas, Houston, and San Antonio. Obviously, Atlanta is a huge hub for us. And then we also have in-depth knowledge and on-the-ground partners in the Carolinas as well as Florida. So these are the markets we'll be more likely to pursue. Next. Okay, go ahead, Chris. Show them some examples.
So we have a couple case studies. I'm going to run through these quickly as we have a lot of questions piling up, and I've taken a quick peek and they're really good. So I want to make sure that we have time to get to them. Okay, so refinance, we kind of went through this, a group that purchased in 2021 using variable rate bridge loan. Once cap rates expanded and interest rates went through the roof, whether there's a rate, typically if the deal is still viable today that had some level of a rate cap, they're looking at getting a cash in refi or a cash neutral refi, but they still have to have the capitalization to pay the origination fees and things of that nature. It's typically going to need somewhere between a $3 and $5 million pref check. And the goal for that sponsor is to get, into something like a 5.6, 5.8 fixed rate stabilized loan. The fund is going to take on the majority of that cash flow. The investors that are already in that deal are going to have stability. They might not be getting the distributions they were hoping to get, but they're no longer worried about losing their principal, and there's a lot of value to that. And the group, that's managing the deal is now getting help from Viking to really make sure that this thing, gets in the green and starts operating a little bit more efficiently with the capital injection that it needs. Next case study. Okay, so this one, the ESG case study. So this is an interesting idea because everybody loves the idea of ESG. It's really popular amongst multinational companies, smaller private equity companies. Everybody loves the idea of doing this, but typically what causes it to not happen as often as folks would like is it isn't profitable. So how do I do this and go through the brain damage of all of this extra work and actually get a profit from it? Traditional multifamily, when you're doing an acquisition, like having really large purchases of solar panels and all of this while you're trying to do your CapEx isn't always viable. But once you get your CapEx done, once you get everything organized and you're increasing NOI, there is a structure that we believe is going to work on some of these deals, and we've been evaluating it for Viking deals, for the last few months. And that's using a pref equity, group to bring in, buy the solar panels. When you put the solar panels on the property, you bring the property to net zero. The tenants aren't necessarily the ones getting to take advantage of being at net zero, because what ends up happening is they pay back the sponsor, at a reduced rate. So they're getting some discount to the fees that they were paying for electricity already. But what the sponsor's getting is they're getting revenue added to their NOI that usually would have just been a pass-through fee to the electric company. So they're growing NOI, they're adding value to the property by having these panels there. So when they reposition and sell, this value is on there. And then the kicker is, when you put on a massive solar project onto one of these multifamily properties, couple hundred units, what you also get is a federal tax credit in the form of, $300,000-$400,000 that you can sell. And you can sell that immediately and take that money. And if it's in a fund investment, that money is available, to be dispersed amongst cash flow or shoring up pref. So, in our preliminary underwriting, and as we dive into this is becoming the way that we think ESG can finally make sense in some of these deals.
All right, guys. That was our official information points, but I want to really get into some of these questions. I know you guys have a ton of really good questions, so let's do it. And let's see. The number of question people are saying is, how does Viking get the 8% if the deal can't sustain it? And so that's something to that effect, Chris. So can you sort of
Yeah,
explain?
so I mean that's
Really,
an
yeah,
easy answer,
yeah,
because if the deal can't sustain paying a 9% cash flow from day one, it's not a candidate for the fund.
right.
So that is just simple as that. So we're going to, just like any other deal, we're going to look at the rent roll. We're going to dive into the financials of the property. We're going to look at their loan covenants and see what kind of loan they have with, whether it's an agency or a debt fund or whoever they borrowed the money from. And we're going to evaluate from a cash flow perspective based off of reasonable assumptions that we build in our model to see what they're going to be able to afford or not be able to afford after debt service.
And
Go ahead.
what are the possible downsides of this hero fund?
So I think, there's a few downsides. So are you able to invest in something and get more than 11% preferred return or an 8% current? So as you're looking at deals, you might be able to find a deal where you think you can get a stronger return. You could look at that as a downside. My argument to that would be, do you have the same risk profile? I think for being a risk-adjusted return and being at the top of the capital stack, being able to get an 8% current and a 12% pref with, some additional money maybe on the back end as GP gets its true value. I think that probably positions well against, a different type of project. Other downsides are, you just like Vic said, you're investing in the people. So if you think that Viking does a good job underwriting its deals, if you think that our experience has told you that, we're capable sponsors, capable at modeling, that's where this could go wrong, is if we didn't model the deals properly and they wouldn't be able to pay the cash on cash return. So, as you evaluate these deals, as you evaluate pref opportunities with other sponsors, really what I would urge you to do, and, just like if you're on an investor call with me, is ask the questions, really get comfortable with the people that you're working with, because you're really investing in Viking, the company, and not the particular asset.
And actually, you can slide to the next slide so they have that to scan as we're answering the Q&A. So guys, my number one request is please book a call. Our team's on standby. We have a lot of interest already, pre-interest from all the people we spoke to in the last couple of days prior to the webinar, who are getting a sneak peek of the fund. So book a call, scan the QR code. If the team can put in the chat box the QR code as well. I'm going to keep cranking through these questions, but and I don't, it's not a big fund. It's very small for us. So this will probably get filled up very quickly. So take advantage, get your questions answered, and then join us. But there's some really good questions out there. A lot of people are wondering, hey, tax consequences, bonus depreciation. I know we all love our bonus appreciation. Um, Chris, what's your suggestion? Because I think you did state that this is more of a cash flow play and and sort of a accrual play as well.
Yeah, as I've been talking to folks about this fund particularly, once they found out, people have reached out. This isn't the only thing that you should be investing in. So, and it isn't large enough for it to be the only thing that you're investing in. It's really a tool as you're building your investment strategy to reduce some risk. There's going to be bigger swings that you're taking that are a little bit higher risk, and you feel like they fit your risk profile. Maybe you're comfortable with the area, maybe you're comfortable with the sponsor. And some of those are going to create bonus depreciation. But as you're building the puzzle that is your investment strategy, this is just one tool for you to use to reduce your overall risk. And then you'll get bonus depreciation somewhere else.
People are asking, hey, is how is Viking going to swiftly take over if the sponsor is delinquent?
Yeah, absolutely. I mean, this will be built into the covenants in the agreement that we sign with the sponsor. So if they go into default, which would mean that they haven't paid us for 30 days or 60 days or whatever, however it's written in our loan docs, we are able to take over and become the operating entity in relationship to that deal. So we would take over their debt relationship and we would start working with that lender to create a workout situation where we now own the LLC that is operating the asset. So, obviously there would be, legal proceedings involved, but it would be just like a bank taking over a property where they didn't pay their debt service. Similar function.
Jessica's asking a good question. Is there any insights provided to investors regarding like the type of deals that are going on or, the health of the investments as they move forward?
Yeah, I imagine that as we make placements and investments, we're going to be sending out profiles of what we're looking at, what the funds are going to go into. But really, they're all going to fit within the defined buy box that we explained here, which is a certain vintage, a certain, DSCR, a certain, they're going to fit all of the criteria, and we're not going to bend on that buy box. So they will, be a certain type of asset, and if they don't fit those criteria, they won't be a good candidate for the fund. But yes, we will be. It isn't going to be a situation. I think maybe this answers the question better. This isn't going to be a situation where you say, I want to invest $100,000 and you send in $1,000. And then every time there's a new opportunity to invest in that, we call that capital and you make a decision then. When you invest in the fund, you really are trusting that Viking is going to do what it says it's going to do, and find these properties that are going to pay these returns. And that's how you invest and start accruing those returns right away.
David had a good question. Will Viking use the Hero Fund in its own deals? And we'll evaluate it. Again, we're gonna follow that strict buy box criteria that Chris was mentioning. That ESG opportunity does look promising, but again, this is all based on a deal by deal basis. There's a ton of opportunities already out there, and so we'll evaluate all the opportunities to see which makes the most sense. How do you determine the profit for Viking versus investors? Is it a fixed 80-20, or is there some type of split or something of that sort? So Jessica's asking that question.
So the profits above the pref, depending on your class, would be a 50-50 split. So essentially the way it would work is you're getting the first up to 13%, depending on what class you're in. And then the profits outside of that 13%, which are typically going to be the value of those co-GP pledges, are going to be split 50-50 between the pref investors and Viking as the fund manager.
Here's Daniel's having a good question. When searching for deals, if an operator did not hedge the rate caps, what other qualities would make this a good operator?
I'm sorry, could you repeat that, Vic? I was
So
reading it.
sure. It's when searching for deals, if an operator did not hedge the rate caps, what other qualities would make this a good operator? I guess they're yeah, just maybe just talk about if they don't have rate caps and they're floating, it probably wouldn't be a fit for our fund because that's not a stable asset if there's no rate caps. But
Yeah,
yeah,
it would be rare if there was someone that had such a strong deal that even with 8.5% interest for the last year and a half didn't kill the deal, and they qualify for a refinance and they're looking for 2 or 3 million and the property is just that strong. It would be a unicorn, but I would say that that probably doesn't exist.
yeah. George asked another great question. What is the fund level return for Hero, and what percentage, and how is Viking getting profit from it as a fund manager?
Sure. So Viking will be getting an origination fee of 1% of money that it places, and that would be paid by the sponsor. So that's one way Viking's making money. There will be some fund management fee, and there'll be a disposition fee. Outside of that, there's no asset management fee.
Jay's asking, does the time to exit of the opportunity play into the decision to invest?
Yes, it would. If you were looking at something that wasn't going to be viable for 9 years, that's how long it was going to take to turn around. Even if it would be viable in 9 years, that time horizon wouldn't necessarily make sense. So we're looking for deals that are going to be able to be, turned around swiftly, and that we're going to be able to see more of an immediate impact. This isn't engineered to really be rescue capital. It's more engineered to be capital that can come in and solve an immediate problem and very quickly turn something around. Some deals just aren't going to be viable, and just like traditional lenders, like we won't be able to help those deals
You know,
out.
Andrew had a really good question. Any vintage concern given between 30 to 50-year-old assets will need updating CapEx?
Yeah, I would say anything that has a high risk of deferred maintenance. I mean, it's all relative because you could have a 70s property where the sponsor has shored up all the capex, the roofs are in good shape, the ACs are in good shape, the electrical's in good shape. And when you start modeling that out and you start taking everything into consideration, a 70s property might be a better value than a 90s property that has a ton of deferred maintenance issues. And that might steer you in one direction. It's hard to pinpoint one thing that would make or break a deal, but it would all be taken into consideration.
And I can stack on that. So, in our history, we started off, buying more C-class properties, when we first started in 2015, 2016, but we've over the years moved more to the Bs and now more of the As. Um, there are usually these 70s and 80s properties are not native 70s and 80s. That means there's several rounds of ownership from institutional quality owners to even just really good owners that have infused capital to where it's a relatively new clubhouse. It's relatively new interiors of these units. And so to try to find a classic or vintage 70s, 80s is probably rare, like where nothing has ever been done to the property. So that's something to keep in mind. But good question. All right. Let's see here. I think those are, we have probably a few more questions, but I think the best way is to probably book a call with our team, as I just definitely want to make sure you guys wrap up at a reasonable time today. But I think this is really good interest. We have, we're really a transparent company. So if there's anything you have, just please talk to Chris and my team. They'll be able to really break a lot of this down. And we got one more here. Some of my physician colleagues have vetted for multiple deals, not paying distributions. Um, how will this be the case on new deals? So, if there's properties that are not performing, uh, how does that support us on new deals?
Yeah, I would say that any market wide, if you have a property that isn't current with distributions and distributions are paused, they're typically in some stage that is capitalizing the property in order to put the property in its best possible outcome. So just because a property is not paying distributions doesn't mean that the property is not doing well. And it doesn't necessarily mean that it's going to need support from something like the Hero Fund. There's a lot of properties out there that aren't paying distributions because they're going to use the cash flow from that property to pay for the rate caps. If they're able to do that, then they don't need the Hero Fund, and they don't need to put on an extra layer of capital that's going to have an additional cost. And there are, Viking properties that are in that situation.
Awesome. Great. All right, guys. Fantastic. Yeah. One last question. If 100K is invested, when will the cash out be typically?
It's going to fall within that 1 to 5 year range, but I imagine there's going to be some properties that cash out in the 1 to 3 year range. And as properties cash out, it's going to go back to the pref investors pari passu.
Awesome. All right, guys. Thanks for joining us here. Please book a call, scan the QR code. A lot of great questions. Appreciate everyone taking time out tonight. And Chris, thanks for co-hosting this with me, and look forward to catching you all soon. Here's our website and here's the QR code. So please take advantage of it, and we'll see you guys soon.
Of course. Thanks so much. Thanks, everybody.